All right, so, we love to dive deep into these resources that you send our way. And this one, I was particularly excited about because it's something that I think a lot of people struggle with.
Mm.
It's how to actually, start investing when you maybe feel like you're starting from zero, budget-wise.
Yeah, absolutely. I mean, it can feel really intimidating, right? Like, where do you even begin when you don't have a ton of cash to throw around?
Exactly. And this resource, really tackles, those kind of initial hurdles, the practicalities
Yeah.
that I think stop a lot of people from even trying.
Yeah, for sure.
So, our mission in this deep dive is to really unpack that information for you,
Yeah.
pull out those truly important insights, and give you, some clear, actionable steps that you
Mm.
can take so you can walk away knowing that, investing isn't just for the wealthy elite or people who already have a ton of money.
Right.
It's something that you can start doing right now, no matter the size of your wallet.
Absolutely. And I think that's what's so great about this resource is that it addresses all those questions that I think a lot of us have when we're first starting out.
Mhm.
Like, can you genuinely start building something with just $10 or $50?
Right.
Like, what are the real viable options out there for someone who's just beginning and maybe a little nervous about risk?
Yeah.
And, what are the safest routes you can take as you get started?
Mhm.
So it's all about making those first steps feel less intimidating.
Exactly. So let's, dive in and explore what this resource has to tell us.
Yeah, let's do it. And the first thing that it addresses head on is whether, you, our listener, can actually begin investing with a small amount, like $10 or $50.
Okay.
And the answer is a clear and encouraging yes.
Okay, so for someone who might be thinking, how can my 10 bucks even make a dent in anything?
Yeah.
What's the key here?
Well, it all comes down to something called fractional investing.
Okay.
So think of it like this. Instead of having to buy a whole share of a company, which could cost hundreds or even thousands of dollars,
Yeah.
many platforms now allow you to buy just a tiny slice, a fraction of that share.
Okay.
And this applies to stocks exchange traded funds or ETFs.
Mhm.
And you can even get started with as little as $1 in some cryptocurrencies.
A single dollar?
Yeah.
Wow. Okay, that really does level the playing field. So
Yeah.
you don't need to wait until you've saved up, thousands of dollars to get your foot in the door.
Exactly. It makes investing accessible to almost anyone, regardless of their current financial situation.
Yeah.
And the resource also highlights a really important point, which is that many apps now, like Robinhood, M1, Finance Public, they offer commission-free trading,
Oh, that's good.
which means that those small amounts that you're investing
Right.
aren't immediately eaten away by transaction fees, which can be a real drag when you're dealing with smaller sums.
Yeah, those fees can really add up and make you feel discouraged when you're making those initial smaller investments.
Yeah, exactly.
Okay, so starting small is definitely within reach.
Yep.
Now, for someone who's just beginning, what does the resource say are the best ways to actually put that small amount to work?
So the resource points to a few really solid options for beginners on a budget.
Okay.
First up are ETFs.
Okay.
So think of an ETF like buying a whole fruit salad instead of just one apple.
Okay,
It's a collection of different stocks or bonds all bundled together.
got it.
And this gives you instant diversification, which is like having a safety net.
Right.
If one fruit doesn't do well, you still have the others.
Mm.
So this is super important for beginners as it helps reduce your risk without needing to pick individual winning companies.
Yeah, I love that fruit salad analogy because I think that makes diversification really click.
Yeah.
So you're spreading your potential across a wider range right from the start.
Exactly. And then there are index funds, which are similar to ETFs, but they're specifically designed to track the performance of a particular market index,
Okay.
like the S&P 500, which represents the 500 largest companies in the U.S. These tend to have very low management fees because they're not trying to outperform the market, just mirror it.
Mhm.
So it's a low-cost, diversified approach that's ideal if you're looking for something relatively hands-off.
Okay, so kind of a way to invest in the overall health of the market
Exactly.
without needing to be an active trader.
Precisely. The resource also reminds us about fractional shares here,
Yeah.
emphasizing again that you don't have to buy a full share of a company like Apple or Google if it's too expensive.
Right.
And finally, it recommends robo-advisors.
Okay.
These are like automated financial assistants such as Betterment or Wealthfront
Right.
that build and manage an investment portfolio for you based on your financial goals
Hmm.
and how comfortable you are with risk.
Okay, so a good mix of options there. ETFs for broad diversification index funds, for tracking the market at a low-cost fractional shares, to access potentially pricier companies and robo-advisors if you prefer a completely managed approach.
Exactly.
Now, safety is probably a big concern for many people who are just starting out. What does the resource highlight as the safest ways to invest those initial small amounts?
Yeah. Safety is definitely paramount when you're just getting started.
Right.
And the resource points to a few options that are designed to protect your initial capital while still giving you some opportunity for growth.
Okay.
So first, it mentions high-yield savings accounts.
Okay.
Now, these aren't strictly investments in the stock market sense,
Right.
but they are a safe and reliable place to keep your emergency fund and earn a bit of interest
Yeah.
while you're getting your feet wet with investing.
Definitely good to have that solid base covered, a safe spot for those unexpected expenses.
Absolutely. Next up are government bonds.
Okay.
So these are generally considered very low risk because they're backed by the government, offering stable returns, although typically those returns will be lower than what you might see in the stock market.
Got it.
And finally, the resource circles back to those broad market ETFs or index funds.
Yeah.
So by investing in a wide swath of the stock market rather than just a few individual companies, you significantly reduce your risk.
Yeah.
So as the resource puts it, these options aim to protect your money while still allowing it to grow steadily over time.
So safer doesn't necessarily mean no growth at all.
Right.
Just a more measured and stable path.
Yeah.
Now, a question I know many people wrestle with. Should you be laser focused on paying off debt before you even think about putting money into investments?
That's a really critical question, and the resource provides a thoughtful answer.
Yeah.
It emphasizes that it really depends on the kind of debt you have.
Okay.
So the big factor here is the interest rate.
Hmm.
So if you're carrying high interest debt, generally considered anything above 7%,
Okay.
things like credit card balances,
Right.
the resource strongly advises prioritizing paying that off first,
Okay.
because the interest you're accruing on that bet
Mhm.
is likely to be higher than what you could reasonably expect to earn from your initial investments.
Right.
So financially, it makes the most sense to tackle that high-cost debt first.
Yeah, that's a no-brainer, right? You don't want to be earning, say, 5% on an investment
Yeah.
while you're bleeding 18% on a credit card.
Exactly. However, the resource suggests a different approach for low-interest debt, typically below 5%.
Right.
Things like some student loans or a mortgage.
Right.
In these cases, it might be feasible to invest while still making your debt payments,
Okay.
because the lower interest rate makes it more likely that your investments could potentially earn more than what you're paying in interest on the debt.
Okay, so high-interest debt takes priority,
Mm-hmm.
but with lower interest obligations,
Right.
you might be able to balance both investing and debt repayment.
Exactly.
Now, once you've decided you're ready to invest, how do you even begin to choose where to do it?
Right.
There seems to be an overwhelming number of online platforms.
Yeah, absolutely. And the resource lays out a few key things to consider when choosing an investment platform.
Mhm.
So first and foremost are low or no fees, especially when you're starting with small amounts.
Yeah.
You don't want a significant portion of your money going to transaction costs.
Yeah.
So as we mentioned earlier, platforms like Robinhood and Webull are known for not charging commissions, which can really save you money in the long run.
Yeah, definitely a big plus in keeping more of your initial investment working for you.
Right.
What else should you be looking for in a platform?
Well, ease of use is another really important factor.
Okay.
Particularly for beginners, the resource points out that apps like Acorns or Stash often have very user-friendly interfaces and can even automate the investment process for you,
Nice.
making it super simple to get started.
Yeah.
Finally, you need to consider the investment options that the platform offers.
Right.
So some might focus primarily on stocks,
Mhm.
while others give you access to a broader range of assets like crypto bonds or even real estate.
Okay.
So you'll want to choose a platform that offers the types of investments that you're interested in and feel comfortable with.
So prioritize platforms that are easy to navigate. Don't nickel and dime you with fees and offer the kind of investments you're looking to make.
Exactly.
Now, I've heard this term dollar cost averaging come up quite a bit. What exactly is it, and why does our resource recommend it?
So dollar cost averaging, or DCA, is a really smart strategy, especially for beginners.
Okay.
It's where you invest a fixed amount of money at regular intervals, say $50 every month,
Okay.
regardless of what's happening in the market at that particular time.
Right.
And this approach has a couple of key benefits.
Okay.
Firstly, it helps reduce the impact of market volatility.
Yeah.
So you're not trying to guess if the market will go up or down.
Right.
You're simply investing consistently over time.
So if the market takes a dip, your fixed $50 buys more shares. When prices are higher, it buys fewer shares, So it kind of evens out the cost over time.
Exact. Think of DCA as your secret weapon against emotional investing.
I got
By sticking to a regular investment schedule, you're less likely to get caught up in the hype when the market is booming or panic sell when it's going through a downturn.
Right.
The resource also highlights that DCA can help lower the average cost of your investments over the long run and smooth out those inevitable market fluctuations.
Makes perfect sense. It takes the pressure off trying to time the market,
Yeah,
which is notoriously difficult even for experienced investors.
exactly.
Now, another kind of foundational question, should you jump into buying individual stocks, or are ETFs a better starting point?
So for beginners, the resource is quite clear. ETFs are generally the safer way to go.
Okay.
The big advantage here is instant diversification.
Yeah.
When you buy a single ETF,
Hmm.
you're essentially buying a small piece of many different companies all at once,
Right.
which spreads your risk.
Yeah.
If one company in the ETF doesn't perform well,
Right.
it's less likely to have a major impact on your overall investment.
Whereas if you put all of your initial, small investment into just one individual stock,
Yeah.
and that company, hits a rough patch, your entire investment could be significantly affected.
Exactly. The resource does note that individual stocks can offer the potential for higher returns,
Mm-hmm.
but they also come with a much higher level of risk.
Right.
If you do decide to venture into individual stocks as a beginner,
Yeah.
the advice is to only invest in companies that you truly understand
Okay.
and to do thorough research into their financial health.
So for someone just starting out, ETFs offer a broader, safer entry point.
Yeah.
Individual stocks are something to approach with caution and a good understanding of what you're investing in.
Exactly.
Now, once you've made these initial investments, how long should you generally plan to hold on to them?
Well, the resource emphasizes that long-term investing, generally meaning holding your investments for at least 5 to 10 years, if not longer,
Okay.
is typically the most effective strategy for building wealth over time,
Hmm.
while the stock market will have its ups and downs in the short term.
Yeah.
Historically, it has shown a clear upward trend over the long haul.
Okay.
So it's about having a longer vision
Yeah.
and not getting too caught up in the day-to-day or even year-to-year market swings.
So it's about patience and, riding out those inevitable dips.
Exactly. The resource cautions against selling too soon,
Right.
especially if it's triggered by short-term price drops.
Right.
Remember, markets tend to recover.
Mm-hmm.
It also touches on the incredible power of compound growth,
Yes.
which we'll delve into shortly. But the longer your money stays invested,
Yeah.
the more you can benefit from those earnings, generating even more earnings.
Patience definitely seems to be a key ingredient in successful investing.
Yes.
Now, for those of you who might be interested in picking your own ETFs or even individual stocks down the line, what are some things the resource suggests looking at to evaluate if it might be a good investment?
So before you invest in a specific stock or ETF, the resource recommends checking a few important factors. Look at its historical performance. How has it performed over the past 5 or more years?
Right.
This can give you an idea of its track record.
Okay.
For individual stocks, understanding the company's fundamentals is crucial.
Mm-hmm.
Things like their revenue growth, how are their sales trending,
Right.
their profit margins, how efficiently are they making money,
Okay.
and their debt levels, how much do they owe.
Got it.
For both stocks and ETFs, it's helpful to consider the broader industry trends.
Okay.
Is the sector the company or ETF operates in growing, like technology or renewable energy, for example?
Right.
And for ETF specifically, the resource points out the importance of the expense ratio,
Mm-hmm.
which is the annual fee charged to manage the fund.
Yeah.
Generally, a lower expense ratio is better
Right.
because it means less of your potential returns are being eaten away by fees.
Yeah, definitely.
For most beginner-friendly ETFs, you'll want to look for expense ratios below 0.20% annually.
Got it.
That means for every $100 you invest, less than 20 cents goes towards fund management.
So it's a bit like doing your homework.
Yeah. Yeah.
Looking at the past, understanding the present health, and considering the future potential, while also keeping an eye on those costs.
Yeah, exactly.
Now, what if the whole idea of, analyzing stocks and ETFs feels completely overwhelming?
Yeah,
Can you still invest successfully without becoming a market expert?
absolutely. According to the resource, it's definitely possible to invest effectively.
Great.
But even if you don't have a deep understanding of the intricacies of the stock market,
Mm-hmm.
it suggests a few really accessible options.
Okay.
One, as we discussed earlier, is using robo-advisors.
Yeah.
So these platforms handle the portfolio construction and management for you
Right.
based on your individual goals and how comfortable you are with risk.
Mhm.
So it takes a lot of the guesswork out of the equation.
So a great option for someone who wants to participate in the market but doesn't feel ready to make those specific investment decisions themselves.
Exactly. Another option is to simply invest in broad-based index funds that track the entire market. It's like an S&P 500 index fund.
Right.
By investing in a fund that represents a large segment of the market, you're not relying on your own ability to pick individual winners.
Yeah.
And finally, the resource mentions target date funds.
Okay.
These are mutual funds that automatically adjust your portfolio's asset allocation over time,
Interesting.
becoming more conservative as you get closer to a specific date, like your retirement.
Oh, okay. So they kind of shift as you get closer to that target date.
Exactly.
Okay. Those sound like really user-friendly ways for beginners to get involved and start building their financial future without needing to become a Wall Street analyst overnight.
Exactly.
Now, how much of your income should you ideally be aiming to invest? Is there a magic percentage?
So the resource provides a common guideline. Try to invest at least 10 to 15% of your income if your budget allows.
Okay.
However, it also strongly emphasizes that if you're just starting out, even investing small amounts, like $5 or $10 per week, is a fantastic habit to cultivate.
Yeah.
The real key here is consistency.
Small, regular investments can really grow into a significant amount over time,
Right.
especially when you factor in the power of compound interest.
Compound interest, often called the eighth wonder of the world. Can you explain what it is and why it's such a powerful force when it comes to investing?
Absolutely. Compound interest is essentially earning returns not just on your initial investment,
Right.
but also on the returns you've already earned.
Okay.
So the resource gives a great illustration. If you invest $1,000 and earn a 10% return in the first year, you now have $1,100.
Right.
In the second year, if you earn another 10% return,
Yeah.
you're earning that 10% not just on the original $1,000,
Okay.
but on the new total of $1,100,
Oh.
resulting in $1,210.
Right.
That extra $10 in the second year is the magic of compounding.
Got it.
Over time, this snowball effect where your earnings generate further earnings.
Can turn even relatively small initial investments into a substantial amount over decades.
Hmm.
The longer your money has to grow, the more powerful this effect becomes. As someone wise once said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it.
That really hits home. So it's like your money starts working for you, and then the money it earns also starts working for you, creating this amazing snowball effect over time.
Yeah.
The earlier you start, the longer that snowball has to roll and gather size.
Exactly. Time is your greatest ally when it comes to harnessing the power of compound interest.
Okay, now what about those of you who might have irregular income?
Yeah.
How can you approach investing when your paycheck isn't always the same?
So the resource provides a few really adaptable strategies for those with irregular income.
Okay.
One is to adopt a flexible investment schedule. Invest lump sums when you have extra cash available instead of trying to stick to a rigid monthly amount.
Got it.
Another interesting idea is to utilize roundup apps like Acorns. These apps link to your bank accounts and credit cards and round up your everyday purchases to the nearest dollar, investing that spare change automatically.
Oh, that's cool.
So it's a very low-effort way to gradually build up your investments.
Yeah.
Finally, if you have income from side hustles or freelance work,
Right.
the resource suggests earmarking a portion of that extra income
Okay.
to invest consistently whenever it comes in.
Those are some really practical tips, for making the most of your income when it arrives,
Yeah,
rather than feeling tied to a set monthly contribution.
exactly.
Now, cryptocurrency is something a lot of people are curious about.
Yes.
What does our resource say about beginners investing in crypto?
So the resource approaches cryptocurrency with a healthy dose of caution for beginners,
Okay.
primarily due to its high volatility.
Right.
If you are interested in exploring it,
Yeah.
the recommendation is to invest only a very small percentage of your overall investment portfolio.
Okay.
perhaps no more than 1 to 5%. It also advises sticking to more established cryptocurrencies like Bitcoin and Ethereum,
Right.
rather than newer, more speculative coins. And perhaps the most important takeaway is to be fully prepared for significant price swings and the potential for substantial losses.
So tread very carefully, keep it a small part of your overall strategy, and understand that it comes with a much higher level of risk.
Exactly.
Makes sense. Now, looking at the other side of the coin, what are some of the biggest mistakes that new investors tend to make?
So the resource highlights a few common pitfalls to avoid.
Okay.
One is trying to time the market, attempting to predict the perfect moment to buy low and sell high.
Right.
The advice here is to focus on consistent investing through dollar cost averaging instead,
Yeah,
as accurately predicting market movements is notoriously difficult even for professionals.
definitely.
Another mistake is selling your investments too soon, often out of fear when prices experience a downturn.
Right.
The resource encourages beginners to resist the urge to panic sell and to remember that the market has historically recovered from dips over time.
Yeah.
And finally, not diversifying your investments, putting all your money into a single stock or asset significantly increases your risk.
Right.
Remember the fruit salad analogy?
I do love that analogy. So
Yeah.
avoid trying to be a market guru. Don't let fear dictate your decisions, and make sure you're spreading your investments across different assets.
Exactly.
Solid, actionable advice. Now, staying motivated to invest regularly can sometimes be a challenge.
Yeah.
What tips does our resource offer to help you stay on track?
So staying motivated is crucial for long-term investing success. And the resource suggests a few effective strategies.
Okay.
Setting clear financial goals, whether it's saving for a down payment on a house, planning for retirement, or simply building more financial security, can make investing feel more purposeful.
Yeah.
And give you something tangible to work towards. Tracking your progress and actually seeing your investments grow over time, even if it's initially small, can also be a powerful motivator. And finally, automating your contributions, setting up regular automatic transfers from your bank account to your investment account, makes it effortless and ensures consistency without requiring constant conscious effort.
Those are great reminders. Have those clear goals in mind. Keep an eye on your progress to see the fruits of your labor.
Yeah,
And make it as easy as possible by automating the process.
exactly.
Finally, the big question that's probably on everyone's mind: when is the absolute best time to actually start investing?
Well, the resource answers this with a timeless piece of wisdom. The best time to start investing was yesterday.
Okay.
The second best time is today.
I like that.
It really reinforces the power of starting now, no matter how small the amount.
Yeah.
Because as we've discussed with compound interest, the sooner you begin,
Right.
the more time your money has to potentially grow and benefit from those compounding returns.
Yeah.
Even investing a small amount, like $10 per week starting today, has the potential to blossom into something significant in the future thanks to that compounding effect.
That's a really powerful and encouraging message to end on.
Yeah.
So to recap our deep dive into this incredibly helpful resource, starting to invest, even with a small budget, isn't just possible. It's absolutely essential for building your financial future.
Yeah.
Fractional investing ETFs, index funds, and robo-advisors provide accessible on-ramps to get started. It's all about understanding your debt, choosing a user-friendly platform, and embracing a long-term mindset with consistent investing.
Exactly. It's not about trying to get rich overnight,
Right.
but about taking those first steps and building a solid financial foundation for your future brick by brick.
So for you, our listener, I want you to really consider this. What small, consistent step can you take today to begin building your financial future? Even $10 a week has the potential to grow in ways you might not yet imagine. What will your very first investment be? Thanks for taking this deep dive with us.
Thanks for listening.
Yeah, we'll catch you in the next one.
See ya.